Hello everyone, welcome back to Chapter 11, Risk and Return. This is a really important chapter that covers some important concepts that help us understand valuation of companies ultimately. In the initial, it helps us understand the valuation of shares. Now, we study risk and return to understand that additional return usually requires additional risk. I mean, we just want to make sure that they are commensurate in that we're not taking additional risk on without any additional reward. So that's notionally the idea. And portfolio says that we want a diverse portfolio so that overall we're reducing risk while trying to maximize return. So let's go through these important concepts. Basically, equity is really volatile compared to bonds, clearly. If you look at the historical ups and downs of the stock market using any of the indexes like S&P or Dow Jones, you will see that there's far more volatility in the equity market than there is in the bond market. So we want to understand that volatility because that is essentially risk. We are trying to earn the highest average returns when we're looking at the stock market. Risk in everyday terms is the probability of losing some money or all of the money. But when we invest in a portfolio instead of a single share, we end up reducing risk overall while still allowing the opportunity for reward. Portfolio theory was developed basically in the 1970s. It defines investment risk in a measurable way and relates it to the level of return expected. So basically it says the more diverse your portfolio, the more you're reducing risk down to the risk of the market. And we'll cover that in a few minutes. So the return is what the investor receives divided by the amount invested. So whenever you're faced with this kind of a problem, whether it's a bond problem or an equity problem, it's the same idea. What are you getting versus what are you paying to get that return? So on a debt instrument, there's the interest paid over the loan amount, right? Pretty straightforward. That's the percentage that we get as far as a return. When we're looking at the return on a share investment, we have those two components. You'll notice that bottom calculation has D1. D1 means the dividend 1 year out. So it means what is our dividend 1 year out plus, and the P1 is what is the price of the share at the end of year one, assuming that we're going to be selling it at the end of year one. This is looking at a 1 year return. So P1 is, okay, what is the share worth a year from today? P0 is what is the share worth today? So P1 minus P0 is what is the capital gain on that share over 1 year in the value of the share. And then P0 is what would we pay for it today? What is the price today? So it's saying what is the dividend plus the capital gain divided by what we would pay for that share. Expected return. So the expected return is a bit of a market expectation, and each investor has more or less risk aversion around that expectation. So the expected return is, okay, the market is expecting that shares of this nature will generally give this kind of return, but then there's an individual expected rate of return as well. So we're going to talk about both of those. Most of the problems that you will solve will say, your expected rate of return, and they'll be quite specific. And that's kind of the more typical way we solve problems. The concept applies to both the market overall and the individual, but most of the problems are you have an expected rate of return for a given stock, and that's how you do your calculation. So the required return is the minimum rate at which they would purchase that share. So in other words, there's an expectation of future dividends, there's an expectation of future capital gains, but each investor has a different risk tolerance. And so they might have different expectations in terms of how that share will perform. More importantly, the share itself has characteristics that make it more or less risky or more or less volatile. We use those the same way. Risky equals volatile when it comes to share pricing. And so as a result, we should expect to pay more for a share, that has less volatility, and maybe a little less for one that has greater volatility, simply because the returns are more baked in when there's less volatility, and they're more unknown when there's more volatility. But we'll get into that, and we'll even define volatility as beta, so that's coming up in a minute. So most people have negative feelings about bearing risk. So this means that the normal person is risk averse. And so it's not about, some of you might enjoy bungee jumping or extreme downhill skiing and things like that. So you might say, well, I'm not risk averse. The concept of risk aversion in finance is that a normal person wouldn't take on more risk without the expectation of more reward. So by that definition, we are all risk averse, which means you wouldn't pay a lot for a risky stock that might lose all your money in comparison to another equally decent purchase where you're taking less risk, but the expectation of reward is just as high. You would take the less risky, same reward option rather than take a more risky, same reward option. So that's the concept that risk aversion is in finance. The normal person will not take on more risk without getting more reward. So random variable, the idea of, and I think you guys have done stats already, random variable is the outcome of a chance process. There's a probability distribution and the typical one is normal. It's not the only one. You guys might remember that from stats. There's a mean or expected value, which is the most likely outcome, and the mean is the weighted average of all those possible outcomes. And then there's a variance, which is how far from the mean we would expect a typical observation to fall, typically. So in portfolio theory, the return on a share investment is considered a random variable, and the mean of distribution is the share's expected return from the lowest to the highest, with the more likely to be in the middle of the two. And then variance is how likely the return is to be some distance from that mean value. So here's a probability distribution of the return on investment in shares X. So you can see that we've got our nice normal distribution. We have an expected return KX, which is the mean of the entire distribution. And then we have our variances there in terms of the amount, as you'll remember, the amount of likelihood that something will fall in between those two variances. Probably looks quite familiar. In portfolio theory, risk is variability in return. High-risk shares have high probability of earning returns that differ significantly from the expected return. So in other words, it would have a very different normal distribution. A low-risk small variance share is likely to earn a similar return to the expected return. So basically narrower and wider distributions, or in this case, wider and narrower distributions. So here's the example. Large variance high risk would have a wider distribution. Small variance would have a more narrow distribution. So that's what we would expect to happen with a higher risk stock and a lower risk stock in terms of the shape of their distributions. Now, movement in return is risk. The total movement in shares return is the total risk inherent in the share, obviously, but it can be separated into two important components, systematic or market risk. Now, systematic or market risk is basically the stock market itself, and it's kind of what is the expectation of the overall market as far as riskiness at the moment. So how much expected rate of return and risk is there in the stock market right now. And then the unsystematic or business specific risk is specific to that share and that business. How much risk is there in that specific business? So the systematic or market risk is kind of like a base, and the business specific risk is added on company by company. So events and conditions that move returns that are market risk are political news, inflation, interest rates, war, etc. Trade disputes would be in there as well too, as in the tariff disputes that we're seeing right now. Those tend to make the stock market more or less risky overall, and there's an underlying sort of market risk overall. And then business specific risk includes earnings reports and whether a company is meeting its earnings targets, the unexpected death of a key executive, or a labor dispute. Those are all good examples of things that would be business specific or unsystematic, non-systematic risk. And so the market risk plus the business specific risk equals the total risk for a given share. And a portfolio is all the shares that an investor holds, and each share has its own expected return and risk. So that's the concept of the portfolio. excuse me, the return on a portfolio is the weighted average of returns of those individual shares, and the risk is the same. It's the variance or standard deviation of the portfolio's returns. So we can basically map out the relative riskiness of a given portfolio if we understand what's happening with each of the shares in terms of expected return and risk. The goal of the portfolio owner is to capture the highest returns while avoiding risk as much as possible. This is done through diversification. Basically, if we can diversify our portfolios, then we are not impacted by an individual share's performance. The most extreme comparison would be, excuse me, if you've got a portfolio with one share. Clearly, you are at the mercy of how that share does. You've got systematic risk or market risk, and you have a ton of business specific risk. Because if that company happens to have a negative event occur to it, the volatility of that share is going to be quite high. Now, if you have, what is it, 30 shares or more in your portfolio, you will have a whole bunch of different risks. In this case, it'll be betas, and you'll have a whole bunch of different expected returns. And overall, you can, work your portfolio to have the right distribution of returns and distribution of risk. Now, the ups and downs of the individual shares or the individual businesses in some way cancel each other out when they're added together over a substantial number of shares. So we can diversify away the individual risk of each business by having a lot of different businesses and a lot of different industries. So diversification gives us the opportunity to reduce the business specific risk. However, the market risk itself can't be diversified away. The fact that you own shares and you're in the market, you have market risk. So you can diversify away the business specific risk, but you can't diversify away the market risk because, well, unless you have more than shares, right? If you have a share portfolio, it will have the risk of the market if it's well diversified. You reduce the business risk, but you have the existing market risk overall. So here's a good example of that. With one share, you've got a ton of business specific risk. As you add shares to your portfolio, you reduce the business specific risk until you bring it down till it's approximating the market risk overall. So when we add shares to the portfolio that move with the market, it adds risk to the portfolio. If we add shares that are negatively correlated with the market, it will decrease the risk of the portfolio. One of the challenges of this, as we'll talk about when we get into beta, and we've talked about this a little bit, I believe, in class, is that there aren't a lot of negatively correlated stocks in the market. We've had a couple long bear runs, really long, and as a result, there's not a lot of purely negatively correlated market stocks. Typically, when we think about a negative correlated stock, something like gold would be there because people run to gold when the market's not doing very well. So mining stocks and things like that in the gold market will go up when the rest of the market goes down. That is what's called negatively correlated, but there aren't a lot of them out there. So this is a great theory, worked really, really well in like the 1970s, but since we've had the two, sort of crashes with the two bear runs, a lot of this opportunity for negatively correlated stocks has really been reduced. So this is just showing the correlation sort of impacts. Basically, if you choose assets with very low correlations to each other, in other words, they're in very different industries, they have very different reactions to what's happening in the market overall. You've got a perfect negative correlation, you've got a perfect positive correlation, and you've got a less than perfect correlation depending on the types of assets that you choose and the relative risks and how they are correlated to how the overall market moves. As you can see, just the green line, if we have perfectly positively correlated assets that we keep adding to our portfolio to move our portfolio from A to B, then we end up just taking on overall more risk in our portfolio. Whereas if we take perfectly negative correlation, we end up sort of in that crazy red B line that you can see there. So the concept of beta. A beta measures the market risk, and it's basically saying, what is this share, how much does this share vary compared to the market overall? So what the beta is telling us is overall, how volatile is this share relative to the market overall? A really simple way to calculate it, there's actually two calculations for beta, and you don't have to do either of these calculations. One is a simple slope calculation, and I believe the other is sum of least squares. But at any rate, the point is when the market goes up 10%, if your shares go up 10%, they're perfectly correlated. In other words, your beta is 1.0 because it's perfectly moving with the market. The shares that are really volatile, that go up 20% when the market goes up 10%, they have a beta of 2.0. And shares that move less than the market, are less risky than the market, maybe it has a beta of 0.5, that would move, if the market went up 10%, that share would only move up 5%. And the same is true for a drop in the overall market in terms of how a company with a specific beta would move. So you're basically calculating how much did the share go up each day and how much did the S&P index go up each day. And then you do the slope calculation of those two data points over a period of time. That is the beta. And again, I don't need you to calculate it. I just need you to understand the concept and what it's telling you, what the beta is telling you. So here's a good example. Here are all of the calculations, all of the points as far as what happened for the market moving KM and KX, the company's share price. And so they're all plotted and you get this straight slope line that moves through the dots, right? The slope basically of all of those dots that are scattered around the diagram. So a beta of greater than 1 moves more than the market. As I explained, if you've got a beta of say 1.5, market goes up 10%, you're going to go up 15% as a share. That's what's expected because that's what has happened historically. A beta between 0 and 1.0 moves less than the market, and a beta of less than 0 moves against the market. And as I mentioned, shares in gold mining companies can have a negative beta, although this is getting more and more theoretical over time to find negatively correlated stocks, at least in North America. So projecting returns with beta, we need to know betas to be able to set an expected rate of return for any given share. One of the problems is that we're developing the beta from historical data, so it may not be a good predictive indicator, but it is what we have and that is what we use. CAPM is how we use beta and some other important concepts to determine the cost of capital for a given share. So people won't invest unless the share's expected return is at least equal to their required return, and the share price can be estimated based on this required return. So remember, CAPM stands for Capital Asset Pricing Model. This is a really important concept, and you will hear CAPM, beta, weighted average cost of capital, and WACC, all of those terms in your work. The risk-free rate is the rate for which there's no chance of receiving what is less than expected. We've discussed this in class for sure. And that is the current rate of interest on 3-month Treasury bills. Those are the federal government 90-day T-bills. So whenever you are calculating CAPM, the first thing you need to know is the risk-free rate. So you need to figure out what is the 90-day T-bill rate so you can plunk that into your calculation. The required rate of return is the risk-free rate plus the risk premium. Now, a required rate of return is the risk premium for being in the market is a way of putting it. So the risk-free rate, 90-day T-bills, but the risk premium is, okay, to be in the stock market, what do I need to get to take on the extra risk of being invested in shares versus being invested in T-bills, which are super risk-free, which are the least risky investment that there is in Canada. So in other words, the required rate of return is the return required of the market. And you have to be careful when you're calculating these problems, because if you're given the market rate of return or the required rate of return, which is the stock market's expected return, you don't need to do anything with the risk-free rate. But if you're given the risk premium, just the risk premium of being in the stock market, obviously you have to add that to the risk-free rate to get it to be the market rate. So you'll be doing some questions with Anir that will definitely highlight this. So I'll make sure that you guys are clear on that. Okay, the securities market line. It proposes that required rates of return are determined by KRF, that first K there, the KRF, the risk-free rate, the 90-day T-bill rate, so the percentage return of 90-day T-bills. And then the market risk premium, so the market rate, KM, minus KRF again, the risk-free rate, times the beta of that particular share. So that is the securities market line calculation generally as a generic sort of idea. And here's all the, KX is the required rate of return, but I've walked you through those, so I think those are pretty clear. And then if we take a look at the actual security market line, not much to add here. Yep, This is fine. This is what it looks like. So what we can do, if we know what the risk-free rate is, and I think we did this in class too, just before we left, but I know that was a long time ago. Basically, if we have the return on the y-axis and the beta on the x-axis, we know that at beta 0, so in other words, no risk, we can plot the risk-free rate. So at 0 risk, or beta equals 0, which is our x-axis, we can also plot the percentage on T-bills, because the 90-day T-bills, the required rate of return on T-bills, or the exact rate of return on T-bills, and that's KRF, and we plot that, and there we've got a point. Now we need one more point, and the easiest one to determine is the market itself. What is the expected rate of return from the market? That can be KA, and beta of the overall market is always 1.0. Because the relative volatility of the market to itself is 1.0. The market moves with the market. So we can plot another point at beta 1.0, and whatever the percentage is, that's the expected rate of return. And now we can draw a straight line between them. And what we're looking for is opportunities that fall on that line, because if they fall on that line, it's the right balance of risk and return. That's the power of the security market. So the SML is a portrayal of the securities market, and the slope reflects the general level of risk aversion. The vertical intercept, remember, beta 0, represents the investments in T-bills, or risk-free securities. So let's take a look here. This is a good example. So the Calvin Company is got an annual dividend of 1.5, which is expected to grow at 7%. So just looking at our Gordon model down below, we've got, you guys are familiar with this calculation. I'm going to do that one first, then I'll come back up to the required rate of return. You've got the 1.5 dividend multiplied by 1.07 to equal D1. Remember that particular calculation. The required rate of return is what we need in order to calculate the bottom part of the Gordon model. We need K, right? So we need to know the expected rate of return for this stock. So what we do up there just below that A colon, required rate of return, is K is equal to 4. Now that 4 is the Treasury bills yielding 4%, plus, and 10 is the S&P Composite Index, right? That's the market rate of required return, minus that 4% again, that risk-free rate, times the beta. Kelvin's beta is 2, you can see up above. So we multiply all that through and we determine that the expected rate of return for Kelvin stock is 16%. So now we can plug that 16% into the Gordon model there in the denominator, minus that expected growth rate of 7%. And we can estimate the stock price at $178, $177.83. So it gives us an opportunity to say, okay, well, if the market is growing, if the market's expected rate of return right now is about 10%, this company's beta is 2, so it's pretty volatile, right? So it's pretty risky. Let's calculate out what's expected to happen with this particular stock, what it should be valued at in the market, and then we can compare that price that we've calculated to the actual value of the stock in the market to look for opportunities. So adjustments to changing market conditions. The risk-free rate can change, right? Because the T-bills might go up or down as far as the percentage that the government of Canada has to offer to get people to buy those particular T-bills. And a response to change in risk aversion. If people get more or less risk averse, as a result, we can see the market, the line change as well. The securities market line itself will change. I believe this is the last slide, and if it is, looking forward to seeing you at chapter 12. Otherwise, I'll see you on the next slide.